Hi, I'm Matt Culkin, co-chair of Steptoe's Financial Services Group, and welcome to another edition of Steptoe's Financial Services University, where we have a series of short, focused conversations with colleagues from across our firm's practice groups and offices around the world. Today, we're going to talk about estate planning and tax issues, and I'm pleased to be joined by my colleagues Beth Tractenberg and Hahn in our New York office. So Beth, thank you for joining. Beth, I'm going to start with you. You know, when you think about estate planning and working with families, right off the bat, what are some of the more important tips or things that people should think about generally when they are looking for advice?
Generally, people should focus in the first instance on having documents that get their assets where they want them to go, to family members, to charity, to friends. All of these things need to be taken care of with estate planning documents, and in particular, naming a guardian for minor children gets done in estate planning documents. So it's very important for clients to take care of these things and make sure that they can have the assets go where they want and people appointed properly, and then they can rest easy knowing that they've taken care of that. So that's first and foremost.
And I'm guessing that people probably come to you at different stages, either in their life or different stages of the life of a business. Are there certain benchmarks that usually trigger someone reaching out?
Yes, people should be absolutely certain to reach out in a number of different circumstances, because not only do they have the opportunity to get their assets where they want them to go, but there's also the opportunity to do good, efficient tax planning to avoid transfer taxes, which right now are at a top rate of 40% with an $11.58 million lifetime exemption. So when people are going to start a business, or when they're going to have a liquidity event, or when they're concerned about passing business interests down to younger generations, these are all times when they should especially be thinking about planning, both for getting the assets where they want them to go, but more important, for being able to take advantage of situations which allow for efficient planning without transfer taxes. Another situation where people should definitely contact us is if they have a spouse who is not a citizen, or if they and their spouses are not citizens, because then there's special planning that's required in order to be able to pass assets to a spouse without U.S. estate tax. So all of those instances are instances where people would greatly benefit by getting good advice and good planning.
And then I'm curious, that's really interesting. You know, we're coming up on the end of the calendar year. What are some of the things that people should be thinking about as they try to make those last minute decisions?
Well, this calendar year is a special year because we do have an election coming up. I don't want to spend too much time on that, but as I mentioned before, right now there's a historically high exemption amount available to each individual who's a U.S. citizen or domiciled in the U.S., which is $11.58 million. Depending on the outcome of the election, that exemption amount may be dramatically reduced. Even if it's not, though, we recommend every year to our clients that they think about a number of issues. One is making sure that they have their documents in place and they've taken advantage of any planning opportunities. Other things to think about are charitable gifting before year end, so that clients can take advantage of deductions, particularly if they had a lot of income in that year. We recommend that it's a good time also to look at beneficiary designations for IRAs and other kind of retirement accounts. Also look at life insurance and make sure that that is being transferred in as efficient a way as possible, which often involves making sure that life insurance is inside of an irrevocable life insurance trust. So in any year, people should be looking at those things as we approach the year end.
And Beth, I think that you and your team recently published a client alert at steptoe.com that lays out some of these things.
Yes, and we put one out every year at the end of the year to remind people of what they should be thinking about and also to talk about any important changes that occurred during that particular year.
So before we go to Svea, Beth, I just want to run one more question by you. Are there other sort of milestones or sort of life events, either corporate life events or personal life events that we haven't talked about that you want to make sure people are aware of?
Yes. We advise clients always to look at their documents every few years, even if there haven't been major changes, but the kind of major changes that would really require special planning are if clients are getting married, they may want to have a prenuptial agreement, which we can help with. Of course, when there's a death, the remaining spouse has to look at the plan and may want to make adjustments. If there's a divorce, again, it's important to redo the documents to take into account changed circumstances. People also often create trusts for their children when they're born or for grandchildren. So all of those kinds of life events are important events that should cause people to think about looking at their documents again.
Thanks. So Svea, I'd like to turn to you, and I know we're going to talk about specific flows of assets, but maybe if you could just start and talk a little bit about your practice, and particularly as it focuses on cross-border or international estate and tax planning.
Okay, thank you, Matt. We represent many hundreds of individual families and individuals, many of them as international connections. We did tax planning for very wealthy families just before they immigrated to the United States. So there's a lot of planning that needs to be done before anyone becomes a U.S. tax resident or tax domicile for the first time. So any family with foreign connections has some kind of special considerations that should be taken into account. So a typical client of mine would be a second generation of a very wealthy family who came to the States to study or to pursue some business ventures, and then we just decided to stay, but we left behind a lot of wealth that was created by the first generation. And all the planning that normally was done while all the family was abroad is almost irrelevant while some segment of the family is in the United States. So it's very, very important to do pre-immigration tax planning and then continue to monitor the structure after the immigration into the United States to make sure that there are no inadvertent tax consequences. From an income tax perspective, I think the most important thing is to start early. Too often we receive calls from clients or potential clients just a day or 2 days before a closing of a major deal, once they realize how much tax they would be required to pay, and they ask, what can I do? At that stage, there's not much that we can do. So the real time to do the tax planning is at the beginning, when you think that your company is just a startup and you're not sure what is the value. That's the time to call us. It's much easier and cheaper to do tax planning at that stage, and you can literally save tens of millions of dollars if eventually your business becomes very successful. In addition to that, we also represent a lot of U.S. clients in respect of their foreign investments. Many of the tax rules that apply to plain vanilla investments within the United States are changed once there is an investment in a foreign entity or once someone purchases a foreign asset. So we help our clients basically to navigate those rules and make the investment in the proper vehicles such that we do not end up paying double taxation.
So if we could, let's stick with that for a second. I'm curious, particularly on outbound sort of repatriation. What's the common fact pattern, or what are the issues that you work through when representing a client?
Okay, for just to give you just one example, we represent basically a family that decided to invest in a major real estate project in Europe. So they are of course, local real estate taxes in the foreign jurisdiction that we have to take into account. And we want to make sure that we can credit those taxes against the U.S. tax liability of the family. With respect to part of the income, we would like to enable the family to retain the money abroad without paying U.S. tax until it's repatriated back to the United States. So there are different structures that we had to put in place. Some of them that will enable the family to defer the U.S. tax, some of them that will enable the family to take the money back into the United States and use it here in a way that eventually will minimize the global tax burden of the family. That would be a typical fact pattern.
And then just to flip that, you spoke about this a little bit already, but in terms of the family that immigrates to the United States and has inbound tax issues, you talked about the second generation being here for studies or for a career. But that's sort of the generic fact pattern, but what are the specific tax issues or the tax law issues that you find yourself working with?
I mean, normally normally this type of taxpayer, they leave behind foreign assets or interest in foreign entities, and such entities are subject to very onerous U.S. Tax regime unless some certain planning is done beforehand. So, for example, if an individual immigrates to the United States and such individuals owns more than 50% of the shares of a foreign corporation, suddenly becomes subject to U.S. tax on a current basis on most of the earnings of that foreign corporation. And that might come as a surprise to an individual who just moved to the United States and thinks that he does not have to pay any U.S. tax until he actually receives a dividend from the company. So need to explain those rules normally to those taxpayers, and we try to plan around those rules.
So what's interesting that what I've heard from both of you, which is the same in my practice, is the concept of call early and call often, because it's easier to resolve issues at the outset when you can identify them, rather than Zvi, to use your example, 2 days before a transaction closes. I'm just curious, before I let both of you go, if you have any other sort of important tips that you want to remind people about before we conclude.
Well, following on that example of calling early, one of the situations I frequently see is people who are not U.S. citizens or residents who buy property in the United States, and at least half the time I get calls about how not to have that property included in their estate for U.S. estate tax purposes. The client has already purchased the property. So if they come to us before they purchase the property, there are lots of very easy and relatively simple ways to avoid U.S. estate tax. If they come to us after they've purchased the property, particularly if it's a house or a condominium, it's almost impossible to do planning. So that is one example that I run across frequently where calling ahead of time makes all the difference.
Yeah, I almost tell clients, taxes can cost you about 40 to 50% of your profits. So you should invest in tax planning the same amount of time that you would invest in increasing your profit by, actually it's more like 80 or 100%. So if you think about it that way, how much time and effort do you put in trying to increase the business profits, the profits of a business by 40, 50, 60%? You can basically achieve almost the same results by doing a tax planning from the outset.
Zvi, I think that's a perfect way to end our conversation, to note the return on investment for proper tax planning. Thank you both for joining me.
Thank you, Matt.
So that does it for another one of our Steptoe Financial Service University courses where we talked about tax and estate planning. As always, you can check out more of our episodes and learn more about our practice group at steptoe.com. Thanks for joining. We'll see you next time.